Hello everyone, welcome to my channel where I talk about personal finance. Today I'm going to talk about dollar cost averaging. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribed. I will try to personally reply to your comments. There are a few different ways that a person can invest in the stock market. One of the more popular method is called dollar cost averaging. This investing method has been shown to reduce the risk of stocks going down and help protect assets from loss. Dollar cost averaging is an investment technique that many people find to be quite effective. This means that you invest your money at regular intervals over time instead of investing all of your money at one time. Dollar cost averaging is great because it reduces the risk of buying stocks when the market is high and reduces the risk of buying stocks when the market has declined. If you are an investor looking for a strategy to mitigate investment risk, one approach is dollar cost averaging. This could potentially lessen the effect of unpredictable fluctuations in the market, but it also means that your returns may be less. Dollar cost averaging is the strategy for risk management. It involves investing a consistent amount over time to defer the fluctuation of the market. Alternately, you might set aside a set amount each month, such as $300. You will acquire 30 shares if the stock trades at $10 in a month. You will wind up with 25 shares if it rises to $12 later in the month. You will have 37 shares if the price drops to $8 in a month. This is exactly your strategy if you invest in a 401k plan. If you adhere to your asset allocation for a longer period of time, you will be placing a consistent monthly dollar amount into a certain investment allocation. Dollar cost averaging has both advantages and disadvantages that can help investors decide if it is the best investing plan for them. Dollar cost averaging has the advantage of removing the emotional component from your investment decisions. Regardless of how much the price of your favorite investment fluctuates, you will stick to your plan of buying a specified dollar amount. This way, if the price drops in a dramatic swing, you will see it as an opportunity to buy more shares at a reduced price rather than bailing out. Prevent a miscalculation. If you put all of your money in one investment at once, you run the danger of investing just as the market is about to crash. Assume you bought a stock right before the market crash of 2007. You will have lost more money if you had simply put some of your money into the market before the downturn. Because predicting a market bottom is almost always impossible, dollar cost averaging can help smooth out market timings. Of course, the flip side of this coin is that you may lose out on investing at precisely the correct time before a bull market begins to trend upward. The market will continuously increase over time, which is a drawback of dollar cost averaging. This suggests that investing a big sum sooner than later is likely to produce higher results. The market always tends to go upwards, so waiting too long will result in a loss. That's why it will be more adventurous for you if you invest the lump sum now and enjoy a higher return on your investment in the long run. Not a replacement for good investment detection. However, dollar cost averaging isn't a foolproof way to manage all of your investing risks. Even if you choose a passive dollar cost averaging strategy, you will still have to find solid investments and conduct research. You will only be investing steadily into a losing investment if the investment you identify turns out to be a poor one. You will also be unable to respond to changing circumstances if you take a passive strategy. You may receive fresh information about an investment as the financial environment evolves, prompting you to consider your strategy. For example, you would wish to expand your exposure to XYZ company if you hear that it is making an acquisition that will improve its earnings. A dollar cost averaging strategy, on the other hand, does not allow for dynamic portfolio management. Dollar cost averaging could be a suitable technique if you are a less experienced investor who wants to follow a predefined approach to avoid being exposed to extreme market swings. If you are an experienced investor, however, you might be able to earn greater results by actively strategizing rather than relying on dollar cost averaging. Thanks for watching this video, and do not forget to subscribe to my channel.